Now we're talking about financial leverage and how to analyze financial leverage, and I'm bringing you through the process of trying to understand how we do what's called an EBIT earnings per share analysis. Now what I'm about to show you actually is sort of the end of the lecture, and I think you need to understand kind of where we're going to understand all these things we're going to do between now and then. But this is really what the kind of thing you would look at when you finish an EBIT earnings per share analysis. And to put it in graphic form here, note this horizontal axis is EBIT, the vertical axis is earnings per share. We just learned in the last video how to calculate earnings per share, and I showed you how to calculate what's called the financial break-even point. Now when you do an EBIT earnings per share analysis, again, you're trying to decide what capital structure a firm should use. And when we talk about capital structure now, we mean the mix of capital. Should it be 60% debt or 40% debt? Should the equity be 30% or 50%? But what's the mix of the capital that we should be using? And again, an EBIT earnings per share analysis tries to show us the mix of capital that will maximize earnings per share. Now we have a financial break-even point. This is capital structure A, one of our options. And this is the financial break-even point for capital structure B, one of our other options. And so we would have calculated these two things. And by the way, I'm going to give you an example of this in just in the next video. But you would have your financial break-even points. And remember, I told you financial break-even point is the level of EBIT that you have to earn in order to make earnings per share 0. So if you're under capital structure A, this would be the level of earnings EBIT that you'd have to earn, and that would make what? Earnings per share 0. This is the financial break-even point for capital structure B. You have to earn more operating profit, EBIT, to make earnings per share 0. When you see this, a greater financial break-even point, that means this is the capital structure now that has the most debt. How do you calculate financial break-even? Remember, it's the interest plus the pre-tax dollars you need to pay the dividends on your preferred stock. This is more financial leverage. If you have to earn more and more money to reach this financial break-even point now, that's a riskier kind of thing. These lines that you see coming up from here, you'll see that we can calculate that knowing the elements of these capital structures. But basically, the greater the slope of these lines that come up from the financial break-even points, the greater the financial risk, the greater the financial leverage the company's taking. So you can see here that B has a steeper slope than A, which means that A uses less financial leverage, B uses more financial leverage. You should also note that there's a point at which they intersect, and that's what's called the indifference point, which I'll show you how to calculate in the next video or so. But the indifference point is the level of EBIT that makes the earnings per share under one capital structure equal to the earnings per share under the other capital structure. So that's the level of EBIT now. Now, what we use that for is once we know that number, we will say, well, you know, if we expect, and let's just give this a number of $60,000, if we expect our EBIT to be less than the indifference point, then we'd rather be on this line than that line. Why? Because if we're on this line, we would have a lower earnings per share than if we were on this line. And remember, the purpose of this is to maximize earnings per share. If, on the other hand, we expect EBIT to be greater than the indifference point, then we wouldn't want to be on this line, we'd want to be on this line, which is capital structure B, which is more financial leverage. Why do you want to go with it there? Because that would maximize our earnings per share. So again, this is an EBIT earnings per share analysis, and what it's going to do at the end of the day is tell us what capital structure to use so as to maximize earnings per share. This is not maximizing the price of the stock in the market or the wealth of the shareholder now. It's maximizing earnings per share. And this is the tool that we use to analyze financial leverage.